Hello, this is Blake with Financial Markets Language. Today we're going to be going over what happened on March 17th and taking you guys through what's coming up the next week, starting March 20th all the way to the 25th. Recapping what happened on the 17th, the big news, the dollar went down slightly, markets went down slightly, and inflation hedge assets went up. You saw Bitcoin rise almost 8% on just the day, and including the weekend rise, almost up 15% as of March 19th. March 19th. Per ounce. But the rest of commodities saw a deep decline. This includes oil going down to under $64 a barrel, but rebounding before the end of the day up to $66 a barrel, and continues to hold at $66 a barrel at early morning trading on March 19th. Gasoline RBOB went down to 2.45 dollars per gallon. Gasoline RBOB went down to $2.45 per gallon. You saw, as addition to the continuous of this week, the 10-year, 2-year, 30-year, 3-month, 6-month, virtually all bond yields went down massively today. You now have the 10-year sitting at 3.43. You have the 2-year sitting at approximately 3.8. And it looks like coming up, we will probably see these trends continue, as it's predicted that now with the CME Watch tool, the odds of a no rate hike are climbing up to 25% based on the CME Watch tool. The few bits of big data that came out on Friday were industrial productivity, which met expectations at a neutral rate of 0.0, which was exactly as expectations predicted. Last month, it was predicted at 0.3%. The capacity utilization in February came in at 77%, a little bit below the expectation of 77.3, but in line with the previous month of 78 as well. This is not much of a miss, and honestly, this does not really give any clear indication of inflation, the Fed, or the markets going forward. Such a small miss, and also not a key indicator. The US leading economic index was actually quite a surprise. This will more or less predict what the next GDP reading will be, and could easily set the tone for what is broadly perceived to be the output and the direction of the economy. It actually was a surprise on the upside, which despite recent news of, continuing to pile on that there will be less of a rate hike, no rate hike, less continuous rate hikes, this looks like it could potentially cause, especially if it continues to precipitate and leads into the Q1 GDP being much higher than expectations. But it was expected to come in at negative 0.4, a contraction, which is more or less what it was the previous month, which was negative 0.3, so just even more of a decline than January. But in fact, it came out at a positive 0.3. Take in mind, this is just the first revision, so in future revisions, it could be revised down, but just seeing a positive number on GDP definitely shows that there's still a lot of strength in this economy. And obviously, the Q4 and Q3 GDPs came out positive, so being able to see a positive read again would definitely show that, especially a high positive, like over 1%, would definitely show that there's still a lot of work to be done as far as slowing the economy, if that's the key goal to get down inflation. As far as consumer sentiment, you saw it come down way below expectation. Came in at 63.4 as opposed to 67. And it came in at 67 the last month, but we're continuing to see a consumer sentiment downtick. Take in mind, 50 is neutral, so we're still seeing consumer sentiment well above neutral, and this is much different than we saw when prices were madly going up, where almost every time it was negative. But ever since we saw a steep decline, I think around it was a few months after, but ever since November, it's been in the positive. But just to see a big tick down just shows the lack of excess savings and additional capital that people can expend on consumer goods. So if this trend continues, that's definitely another good sign of inflation trending downward. As far as big data next week, the big things that we're going to be looking at are On Monday, nothing is scheduled. But on Tuesday, we have advanced U.S. trade balance in goods. The previous month, it was negative 91.5 billion, which was a small tick up from the previous month, or of December. Take in mind, this is the February reading. They report the previous month, the month after, because we obviously don't know what happened in the totality of March. We have advanced retail inventories. Hopefully they continue to decline. Last month it was at 0.2%. Obviously, the more these climb, the more deflationary it is, but also the more retail stocks will go down as they continue to hold and have to maintain this inventory that's simply not moving off the shelves. So just to see a zero or a slight negative based on just the excess that they've been building over the last couple months would probably be a good sign for them. But if it comes in, that they have a ton of inventory, that is going to be very deflationary. So honestly, could be a win either way, depending on how you look at it, and a small loss, depending on how you're exactly viewing the economy right now. Advanced wholesale inventories are coming out, and similar to advanced retail inventories, it's predicted to be roughly around zero, but this time it's going to be a slight negative 0.1% as opposed to the retail inventories, which are actually going to climb positive 0.2%. But yeah, more or less, it looks like they're both going to come in around zero, which would be about what I think a lot of people would expect. And obviously that's what the expectations are what they are. The S&P Case-Shiller Index, price index for the 20 cities, this is year over year for January, is expected to still be up 4.6%. Remember, we're not going to see these home prices on a year-over-year basis really start to look bad until we get into like June, July, August, because take in mind, in 2022, prices were still going up until that time. We didn't even see prices start to go down until mid-2022. And then you saw that continuing, an exponential decline into 2023, where we are now. We see FHFA home price index, no expectation for this one currently, and probably won't until the release date. And then we have U.S. consumer confidence. Last month it was at 102.9. On this one, 100 is neutral, so a small tick up previous month, no prediction yet. As far as pending U.S. home sales, last month it went up 8.1% because remember, this is also nominal, so typically January is a pretty light month, but we saw quite a tick up in January on the last reading in February. So if it continues this tick up, despite the lack of inventory, that could easily explain why prices are so elevated. But on the other hand, if we don't see, another big tick up in pending U.S. home sales, this could easily be, the coming of the end of why prices haven't fell or are equivalent to what they should be relative to the current interest rate. On Thursday, Monday, March 22nd, 21st, does that make sense? What? Are these days off? Yeah, the days are off on here. Monday, March 20th, we have nothing scheduled. Tuesday, March 22nd, we have existing home sales. The previous month, they came in at 4 million. This month, they're expected to come in at 4.16 million. So even a slight uptick from what we saw in January, which is typically a pretty light month across the board. And February also is even typically lighter than January. So just seeing these high pending sales, existing home sales coming through, despite the lack of inventory, could definitely explain why prices are so elevated relative to the current market and interest rates. But obviously, I think eventually we're hoping to see this tick down so we can eventually get into more of a neutral market and just have the inventory be able to sit on the market without being gobbled up the second it's put on, allowing to not have enough inventory for the amount of buyers. And then the biggest thing of the week that we have coming out Wednesday, remember this is going to be at 2 p.m. Eastern, is going to be the Fed interest rate hike decision. It's currently predicted that they're going to do another 25 basis point hike. But on the other hand, obviously with recent developments in Silicon Valley Bank Signature Bank and other bank failures that have followed or are coming close, like First Republic, you could easily see the backing off from the Fed of interest rates. If there is broad market, pressures within the banking sector, as they reported when they had to close down Signature Bank before they even went negative in liquidity. So having them pull the plug on a bank before they even go underwater is already a bad sign, and obviously them coming out with that definitely shows that there might be a lot of risk in the banking sector that's currently not really known to us individuals. It is really just in the institutional space. But if this comes to light as interest rates continue to hike, we could easily see, mass collapse within the banking sector, and that obviously would be a lot worse than just having a 6% inflation. But obviously, end goal is to get inflation down, and typically every time historically to get inflation down, we would need to have some sort of event to actually be able to get the inflation down, like a recession or a massive unemployment spike. Following this, at 2:30 is going to be the Fed Chair Powell's conference, going over more or less why he picked the rate hike decision that he picked, and then answering questions from the press conference. On Thursday, we have the U.S. current accounts. Is expected to, last month it came in at negative $217 billion. And take in mind, with inflation continuing to stay high and wages lagging to current inflation levels, we could easily see this number continue to grow. And I think that's more or less expected, even though there is no expectations yet. It's more or less a question of how much will this number grow. Obviously, less is better, so that way we could have the Fed continue to hike interest rates without the consumer going massively underwater. But it just kind of depends on how much they're having to subsidize their lifestyle currently to keep going at the rate that they're going. After this, we have continuing joblessness claims. Last month they came in at 1.68 million. No prediction for this current month, but I would expect it to be pretty similar to what we saw last month. Hopefully eventually we can see a tick up in just joblessness claims and a tick down in job availabilities without the unemployment rate going massively up. But historically, you had to have the unemployment rate go massively up. You can't just have a gradual shift and rebalance in the labor market. But ideally, the soft landing crowd are definitely hoping for this number to slowly tick up while having unemployment rates stay pretty even, and also having job availabilities slowly decline to get into a more balanced labor market to stop the wage price pressures on inflation. Also on Thursday at 10 a.m. Eastern Standard Time, we have new home sales. They'll be coming out, expected to be less than the previous month, but not by that much. They're expected to come out at 649,000 as opposed to the 670,000 that they came out in January. This number, it's not that much of a decline, and still there's a lot of new homes being sold. That's what I'm saying. I mean, if existing home sales are at 1.68 million and new home sales are still, hovering around that 600 to 700,000, that definitely shows that there's still a lot of luxury buyers that aren't turned down that much by these high interest rates, are continuing to buy these newer, more expensive properties that are hitting the market. And take in mind, nowadays, new construction is primarily in the luxury space across all of the US. So having that number be so high and having builders still be able to sell at these rates are obviously why you see home builder stocks not decline that much despite a lot of fears of a big housing crash. Virtually no decline in home builder stocks. In fact, many of them are still at year-to-date highs, while the rest of the market is obviously languishing, if you would. And the data coming out on Friday, we have durable goods coming out at a positive 0.7%. Big increase expected from the previous month of negative 4.5%. This is showing that hopefully, despite the job loss within the industrial sector, we're still able to produce a fair amount of goods. And obviously that job loss could have ticked down, and now that we're at this newer, lower level of durable goods, we're able to slowly bounce back with the current amount of personnel that we have working in that sector. Following this, we have the S&P Global Flash US Services PMI. Expected to be a small increase. Remember, everything above 50 is an increase. It's coming out 50.3. The last month was 50.6. We've continued to see services go up, more or less ever since the pandemic. Well, ever since we went more back into a herd immunity mindset as opposed to a quarantine mindset. You've had, essentially, as I'm getting to next, the U.S. global manufacturing PMI continue to slowly tick down, while the services PMI continues to tick up. But now the last piece of data for Friday is, as you guessed, the U.S. global manufacturing PMI, which is coming out at 47, predicted to come out at 47, as opposed to the last month, which is 47.3. So still a much bigger decline than obviously you're seeing an incline in services, and that decline is expected to increase a little bit, but obviously we'll have to wait for the data to come out before we can make a just decision on what exactly is going to be happening with this PMI. One final big thing to note that we saw on Friday, we saw the VIX spike massively, up 11% on the day to almost 26. Take in mind the VIX has been relatively low up until the recent bank failures about a week and a half ago. But up until then, we were consistently sitting below 20, even like around the 17 range for a little bit. But now we're starting to see that continue to climb up as there's more, perceived risk within the banking sector, more uncertainty about Fed rate hikes, more uncertainty about if there's going to be a recession and how bad. And I more or less predict the VIX to continue to go up as these concerns continue to greaten. Obviously, we'll probably see a little bit of relief after whatever comes out of the Fed meeting, which is predicted to most likely be a 25 basis point hike. But on the other hand, if we get surprised with a 0 or 50% hike, or 50 basis point hike, we could easily see this spike massively just in that day and have stocks swing wildly. All dependent on what exactly, Fed Chief Jerome Powell decides ultimately. And that's obviously the biggest data of this upcoming week that everyone's got their eyes on. Best of luck. I hope this data was able to help you go forward in this week. If you need to reach out to me, I am a Florida licensed real estate agent. I can't help you with any kind of fiduciary goods or fiduciary services within Florida or any other state. Feel free to reach out. I have my contact information posted after this. Thank you for listening and hope this is able to help you.